Hallo und herzlich willkommen zu unserem heutigen Scope-Webinar. Mein Name ist Barbara Claus und ich bin Fondanalystin bei Scope. Das Thema heute ist nachhaltiges Investieren in globalen Nebenwerten. Dazu haben wir Jamie Jenkins hier, der Fondsmanager des BMO SDG Engagement Global Equity Fonds, der im März 2019 aufgelegt wurde. Der Fonds verfolgt einen wirkungsbasierten Nachhaltigkeitsansatz nach Artikel 9 SFDR und er orientiert sich dabei an den 17 Sustainable Development Goals, SDGs, kurz gesagt, und wir sprechen darüber, wie der Ansatz in der Praxis funktioniert und natürlich auch, welche Erkenntnisse sich bislang aus der Kombination globale Nebenwerte und Nachhaltigkeit gewinnen ließen, beispielsweise im Hinblick auf das Risiko-Rendite-Profil des Portfolios oder auch auf die Portfolioaufstellung. Bevor wir anfangen, würde ich gerne noch ein paar Worte zu BMO Global Asset Management sagen, für diejenigen, die das Unternehmen noch nicht kennen. BMO steht für Bank of Montreal und BMO Global Asset Management ist der Asset Management Arm der BMO Financial Group, die 1817 in Kanada gegründet wurde und circa 710 Milliarden kanadische Dollar verwaltet und 45.000 Mitarbeiter hat. Die BMO Financial Group bietet eine breite Palette von Produkten und Dienstleistungen an im Privat- und Firmenkundengeschäft, Vermögensverwaltung und Investmentbanking. Der Fokus von BMO Global Asset Management liegt auf nachhaltigen Strategien und die Firma hat 1984 den ersten nachhaltigen Fonds aufgelegt. BMO Global Asset Management war auch bereits zweimal hintereinander, letztes und vorletztes Jahr bei den Scope Fund Awards als beste Gesellschaft im Bereich ESG nominiert. So, bevor wir mit der Q&A-Session mit dem Fondsmanager Jamie Jenkins beginnen, denken Sie bitte daran, dass Sie auch während des Webinars die Möglichkeit haben, Fragen zu stellen. Wenn Sie eine Frage haben, können Sie diese gerne in das Chatfenster auf der rechten Seite eingeben, gerne in Deutsch oder in Englisch, und wir gehen dann entweder im Laufe des Webinars darauf ein oder am Ende des Webinars. So, dann würde ich überleiten ins Englische und den Fondsmanager begrüßen, und ich würde Ihnen aber auch dann am Ende des Webinars noch eine deutsche Zusammenfassung der Kernpunkte, über die wir gesprochen haben, geben. So, then now I would move over to Fund Manager Jamie Jenkins from BMO. So, hello, Jamie, great that we have you here today because I think it's a really interesting themes, ESG and small and mid caps. So thank you very much for being here today.
Well, thank you for having me. It's a real pleasure to talk to you today, and I'm looking forward to the Q&A session.
Great. Then as the first question, I would like to give our participants a little introduction. We've heard that BMO has a long history of sustainable investing. It launched its first sustainable fund in the UK in 1984. So you've been as a fund manager with BMO for more than 20 years already. Could you tell us a little bit about your experiences with sustainable investing at BMO and maybe also how it has evolved over the last years?
Yes, absolutely. So we at BMO, we have over 35 years experience of investing sustainably and investing responsibly. We believe that we launched Europe's first ethically screened fund in 1984. And although I haven't been in the company for quite that long, I have been working for over 20 years at BMO, and I have been investing as a global equity fund manager for coming up for 10 years. Prior to running global equity strategies, I was a Japanese equity specialist. And so that's one of the reasons why we feel particularly comfortable investing in certain Japanese companies, which we can talk about in the fund later.
Yeah, sure. Thank you very much for your introduction. So when speaking about sustainable investing, most people know about the global equity funds focusing on large caps, on theme funds, even on bonds. But on small and mid cap, that focus for me is something pretty new. So can you tell me a little bit about the reasons behind that you have launched a fund for small and mid caps?
Sure, absolutely. We thought it was going to be particularly interesting to design a small mid-cap strategy that really embraced ESG and used the Sustainable Development Goal framework as a framework for building a fund. You know, we think the United Nations Sustainable Development Goals are a great framework for exploring sustainability, for exploring how finance should make a positive contribution to sustainable development. And we at BMO have a really long history of engaging with companies, and we do that both through the investment team, and also we have in-house ESG research specialists. And so we felt we were ideally positioned to build this SDG engagement global equity strategy. And we wanted to be ambitious. We wanted to go into the small mid-cap space and to make sure this was an equity strategy that explored both developed and emerging markets in terms of the companies.
Okay, thank you very much. Now I suggest to dive into the strategy. So can we speak a little bit about your approach in the fund? I've seen that the investable universe is quite large with over 7,000 stocks. So how do you identify attractive companies, and which criteria do they have to fulfill on the financial and on the ESG side? Could you also maybe run us through an example afterwards?
Sure. I think this is a really useful slide to talk to first. You know, so the investable universe is really big. This benchmark we use, which is the MSCI SMID ACWI, has nearly 7,500 companies. And that means that this fund is exactly the sort of fund that you should pay active fees for, because it is very active. The active share of the strategy is in excess of 98%. We only have 50 holdings, and we're trying to beat a 7,500 strong benchmark. So we think it's really differentiated. It's high conviction. The way that we identify attractive companies is quite simple. I've just moved back here to our philosophy. We at BMO have a fantastic network of small and mid-cap specialists in our company. And we have a very rich heritage of identifying investment opportunities. And so, you know, we really seek to leverage the excellent idea generation of my own team, which is a 16-strong global equities team. But then we also leverage the idea generation of other small mid-cap teams around the BMO group. So you know, we basically have a preference for investing in quality companies. These companies, because of their focus around sustainability, typically have a focus towards growth. So quality, growth, and sustainability are the type of characteristics you can expect from the average company in this strategy. But it's you know, when you have such a big universe, you have to reduce it somehow. And so, you know, we basically built a long list of great ideas from speaking to our colleagues in US small cap, UK small cap, European small cap, and emerging market small cap. So we filtered these names down to around 150 companies, which we thought would be very interesting for this particular strategy. We then had to filter down further based on the engageability of these companies. Did we feel these companies for selection, would they be open to our deeper dialogue, to our engagement conversation? So we went through a very detailed methodology of establishing engageability. And only once the company had passed that engageability test did we then take it forward to a further filter process, when we had to think about how each particular company would map into specific SDG targets. This is a fund that's set up around targets, not just the Sustainable Development Goals. So it's very granular. And we went through a very thoughtful, solid methodology to reduce that 7,500 universe down to 150, and then ultimately down to the final 50 companies in the fund that we have today.
Okay, so do you use, in the first step, do you use any ESP filters, or is it more of a insourcing of the best ideas in-house, and you don't have any specific filters you run on the universe before?
Yeah, no, so thank you for the question, Barbara. But because this fund is set up around engagement, actually, this gives us the possibility of considering a wider universe of companies from the best-in-class names that a traditional ESG fund might consider. We are happy to consider companies where ESG ratings are not particularly great. We are happy to consider companies where there are negative impacts on society and on the environment, because we want to use this fund as a vehicle for driving change. We want to invest to improve. And I think you can see on this slide here that although we do apply some ethical and sustainability criteria, these are quite high-level criteria. These are criteria around weapons, tobacco, fossil fuels, and uranium mining. But after that, our universe is actually very, very wide, and even wider than most normal sustainability funds. We want to avoid companies that are involved with breaches of the UN Global Compact principles. And we are focused, of course, around issues like biodiversity, water use, and taxation. But actually, because of our belief in the power of engagement, the utility, the usefulness of engagement, we're happy to consider a wider range of companies. So we don't apply any hard ESG filters as such, apart from these high-level screens. And then this lower half of the page really talks you through how we think about establishing an engageability score. We think about our historic engagement with companies. Are they willing to be engaged? And only once we feel good about that do we take it forward to setting key objectives around specific SDG targets.
Could you please run us through a company example to show us how you do evaluate the companies in regard of their positive contribution to the sustainable development targets? And I'm also wondering, not all companies maybe can contribute positively to all 17 goals. So what goals do you place your emphasis on? Is this company or sector specific also?
Thank you. So what I might do is I might just go back a slide to give you an impression of the breadth of companies that we have in the fund. So, here are 7 overarching positive sustainability themes that we use at BMO Global Asset Management on the Global Equities desk. These are very long-term, powerful, durable themes that we think are going to be very relevant to sustainable development. And of course, for example, health and well-being, that maps very accurately to SDG 3, which is, good health and well-being of the sustainable development goals. But, other themes here don't map perfectly. They cut across multiple SDGs, many of the 17 SDGs. But hopefully here what you can see is a very diverse list of companies. Some will be familiar to you, probably like Wolters Kluwer or Umicore, but then there will be some unfamiliar names. And this is, names like Clicks Group, which is a South African pharmacy chain, which is on the front line of COVID-19 and the provision of health to a population across South Africa. We have Americold Realty, which is a company that is a world leader in cold and frozen food supply chain logistics. They found themselves on the front line of the COVID-19 crisis as they had to deal with a massive switch of food supply channels away from food service back into the home food channel, which was a big stress point for them. But we managed to engage with this company in the very couple of weeks right around the intensity of the crisis. So this proved to us that this was a company that was willing to engage, even though they were under a crisis situation. They were happy to talk to clients, happy to talk to investors such as us. And this is fighting. This is SDG 2 that we hold Americold for, which is ending zero hunger. And through the efficiency of their supply chain logistics, they're on the front line of reducing food waste, which we know is a massive issue for carbon emissions. So we think this company can be very valuable in terms of preventing carbon emissions and wasteful carbon emissions.
Okay, so the relation to the SDG targets is really most important where the company can do most, so where it has the most impact to contribute positively. So we have spoken about engagement, and I'm wondering also if you could give us an example how you have engaged with a company recently, and if you also had the possibility to see a positive impact through your engagement. Could you please also give us an example for that?
Of course. Well, firstly, I'd just like to say, just to step back and just to put our engagement capabilities in perspective. So here you can see that, we at BMO Global Asset Management, we have a fantastic expertise in engagement. And we can engage globally, right across the world. A lot of our engagement is done on desk by the investment specialists, but we also have a 20-strong responsible investment team. This is an in-house team of ESG specialists who sit centrally. They are the central focus of all of our governance and voting globally. And we, as the portfolio managers, we work very closely with the individual members of the responsible investment team to make sure that we understand the ESG issues, that we understand the SDG technicalities when we're talking to companies wherever they are around the world. So we're very lucky to have this team. As you can see, now this data is a little old because it's 2019. But we had over 750 company engagements in 2019. We spanned 45 countries around the world. And this is why we are so well positioned to launch such an ambitious fund as this a couple of years ago. If I may jump forward then to talk about a more specific example. Here we have a company, it's a top 5 holding in the fund today. It's a Canadian US listed waste business. It's called Waste Connections. It's a waste and recycling company, which is classified in the industrial sector. We think that, waste is a massive issue that society, governments, and individuals need to take more responsibility for. This is a company that actually has quite a wide range of SDG targets applied to it. We have them in SDGs 5, 8, and 12. SDG 5 is around gender equality. SDG 11 is one of the goals that we have around sustainable cities. We know that sustainable cities and communities is a huge issue in terms of quality of life for people. And, our experience of investing with Waste Connections over the last 5 years led us to believe that they would be very receptive to engagement and a deeper dialogue around specific SDG targets. A lot of funds that have launched in the last 2 to 3 years have embraced the SDGs, but only at a goal level. And I think this is one of the things that makes this fund very different, is it was designed to go to target and to go to the indicator level, because this is one way that we can track impact, one way that we can navigate our way through the SDG framework. And it's our experience that companies have really appreciated this framework, the design we've put around this fund, because a lot of corporates they're trying to understand how to use the Sustainable Development Goals, how to make them relevant for their business and for their dialogue with their investor base. And so, they appear to appreciate our multiple conversations around SDGs. Here you can see the timeline along the bottom of the page, the timeline of our multiple engagements with the companies. I apologize, it's quite wordy, but there's a lot of information here. And we have logged a couple of milestones with Waste Connections. These are significant moments of improvement using an internal scoring mechanism. For example, at the end of 2019, we saw a milestone around ESG disclosure, which is absolutely key. And we pushed them prior to that to improve their disclosure. And we saw that particularly around diversity and occupational safety. And these are changes that will make a real difference to employees, and they will make a real difference to customers. And so we're happy to see Waste Connections still as a very important holding in the fund today.
Thank you, Jamie, for walking us through that example. So I have one question about the specific small and mid-cap area, because I can imagine that large caps already have a lot of reportings in place, consulting regarding ESG, but maybe the small companies, you can make a greater impact because they might be more agile than a large corporation. Is that something that you have surveyed, because you know both sides, you know the large caps and you know the small cap side?
Yeah, I mean, one of the things we have observed over 30 years of investing sustainably at BMO is that larger companies look better through an ESG lens. ESG rating companies, they prefer larger companies because they are more mature, they have sustainability divisions, they have better sustainability reporting, they have chief sustainability officers because they are more developed as businesses. But it's our experience that many small and mid-cap companies also are very, very good on sustainability, but they are not as well developed in terms of reporting, in terms of having dedicated personnel in charge of sustainability. Often it will be the chief financial officer who's also chief sustainability officer. And so that's where the real opportunity for unlocking alpha for performance lies, because we have observed over particularly the last 10 years, that those companies with the sharpest improvement in ESG scores often deliver the sharpest improvement in performance. So if we can identify small mid-cap companies that are underappreciated for how good they are today and what they can achieve in future, then we can enjoy both an ESG re-rating and also a valuation re-rating. And that's one of the reasons why we have such a successful range of small mid-cap capabilities at BMO, where we have strong client interest around them.
Thank you very much for your answer. Before we move on to performance and also portfolio, I have another question regarding the reporting, because we've spoken about the reporting on the company side, but how important is reporting for your fund, for you, also in regard of transparency and in regard of ESG reporting. Can you tell us a little bit about the reporting you offer?
Thank you, Barbara. Yeah, I mean, for us, reporting is absolutely vital. Particularly over the last 5 years, we realized that fund managers were not doing well enough with reporting. We needed to simplify, we needed to demystify, and we needed to make our funds more accessible, more understandable. And you can see here on this page on the right hand side, we have some thumbnails of publications we produce. This particular fund has an annual impact report, which we're currently working on for the new report. We ask our companies to be transparent with us, but we believe that we should be more transparent with our investors too. And so this impact report provides full look-through data for the fund. It has very detailed revenue alignment mapping for the full portfolio. It has a lot of information around a range of ESG statistics, not just climate, but also gender and diversity issues, which people are increasingly interested around diversity and inclusion. We vote very transparently. That data is available both on our website and in our annual reports. And I earlier referred to our responsible investment team. Well, this is a team that produces a tremendous amount of thought leadership, interesting material which can be shared with clients or just consumed by private investors. And so we as an investment team, and I as the lead manager of this strategy, feel remarkably lucky to have this great framework around us, around reporting. And, I often think a great graphic really explains 1,000 words. And, we do this in the report. We're very granular in information we provide. If you want to go deep into the data, you can do that. But if you want to take a higher level thematic approach and understand what this fund is trying to do, then I'd encourage you to look at this impact report. And we very much enjoy receiving all sorts of feedback about how we can make it better for the coming years.
Thanks. So that's a bit also leading by example, which I think is a good thing, that we also have insight into what is going on BMO level in terms of sustainability, engagement, and voting. So if you're interested in the fund products, also check out the reporting on the website. So I would just take the opportunity quickly to sum up a few key points for our German participants, and then we would move over to the portfolio and performance part. So, bevor wir weitermachen mit dem Performance- und Portfolio-Teil, wollte ich kurz für Sie als Zuhörer die wichtigsten Kernpunkte des Ansatzes zusammenfassen. Also es ist ein Ansatz für globale Nebenwerte, ein sehr aktiver Ansatz mit ESG-Integration, und zwar nach Level 9, nach SFDR. Das heißt, es ist ein dezidierter Impact-Nachhaltigkeitsansatz, der gezielt nach Unternehmen sucht, wo BMO am meisten bewirken kann hinsichtlich der Nachhaltigkeit. Und je nach Unternehmen wird eben geschaut, analog zu den 17 Sustainable Development Goals der UN, wo man quasi bei der Entwicklung den meisten Impact machen kann. Also das hängt sehr, sehr stark vom Einzelunternehmen ab. Beispielsweise, wir hatten das Beispiel von einem amerikanischen Supplier von gefrorenem Essen. Und dieses Unternehmen kann beispielsweise bei dem Sustainable Development Goal, also den Hunger weltweit beenden, den größten Impact machen. Und da setzt man einfach an. Es geht also auch um die Materialität. Generell das Portfolio ist benchmarkfern. Das Universum besteht aus ca. 7.000 Unternehmen. Das Portfolio ist konzentriert und beinhaltet die besten 50 Anlageideen. Und als Quelle der Informationen stehen zum einen lokale Nebenwerteteams, Aktienteams zur Verfügung, natürlich auch das globale Aktienteam, mit dem Jamie Jenkins arbeitet, und ein dezidiertes Sustainable Investing Team mit circa 20 Mitgliedern. So, das war die Zusammenfassung von meiner Seite. Und jetzt gehen wir wieder ins Englische über und machen weiter mit dem zweiten Teil unseres Webinars, wo wir auf die Performance und das Portfolio des Fonds eingehen. So, now let's get back to English for the second part of our webinar. And therefore, I would like to speak with you about performance and portfolio. First, start with portfolio construction. So I'm wondering how you determine the weight of each stock and how your portfolio looks compared to the global small and mid-cap universe.
Okay, so I think if I take the second part of your question first, this looks significantly different, this fund, to the universe, because it's such a specifically large universe. We have some very basic portfolio construction guardrails. We basically we'll have a maximum of 5% in any single stock. We'll typically have a minimum of 1% in any single stock. So that's the range at a stock level. And then, as you'll see in a moment from the slides, you'll see that we have a maximum 10% overweight to a region and a 10% overweight or underweight to sectors. The reason that we do this is to make sure that we are taking the majority of the risk in this fund at the stock level. We think we're better stock pickers than we are currency forecasters, and we don't want to take too much unintended FX risk through our bottom-up portfolio construction. We also use a number of pretty detailed portfolio construction tools to try and make sure that we size our positions appropriately. We observed when we were building this fund over 2 years ago that it would be most likely to be successful if we had a structural underweight to the most volatile companies, if we had a structural underweight to the smallest companies. So when we look at the small mid-cap universe, we have an overweight to mid-cap names, and we have an overweight to lower volatility names. So this is a fund that has a beta of about 0.9. We decided that would be the best way to start this fund off, and we have observed that the risk-adjusted return has been very attractive, particularly during the pandemic sell-off when we saw the big drawdown in markets. This was a fund that performed extremely well when the markets drew down, and so that, I think, makes it relatively different to a lot of sustainability funds in the marketplace, which tend to be high beta and very geared into the market's progress.
Okay, thank you. Do we have a slide on the current portfolio in there? I just maximized this slideshow now so that we can pick it, so that we can have a look how your portfolio looks in terms of sector.
Yeah, here we go. I'll show you. So here is a sector slide. Sorry, a regional slide. So you can see we have relatively modest overweights and underweights relative to the benchmark. This is the MSCI SMID ACWI benchmark, just to remind you. But on the left-hand side, you can see this is a well-diversified fund. You get a lot of different regional exposures in it. Yes, it has about 50% to North America, but that is still an underweight position. And that's a much lower weight to North America than traditional larger cap indices, where the US would be up to about 70% of the index weight. The sector position slide perhaps tells you a little bit more about this fund, tells you where we have our positions built from a bottom-up perspective. You can see financials, consumer staples, and healthcare are our three largest sector allocation positive areas. And we fund that by being underweight real estate, underweight communication services, and underweight energy, where we have a zero exposure today. Again, on the left-hand side, you'll see a lot of diversification. We think that's prudent to have that sector diversification if you're only going to be investing with 50 companies in such an ambitious fund as this.
Thank you for referring to that slide with the sector allocation, because to me, some sector exposures are a bit unexpected, because I thought compared with the global universe, typical underweight sectors in the in ESG investing would be something like materials or energy. So could you tell us a little bit about the reasons for that?
Yes, absolutely. I mean, one thing worth saying is, so we are underweight energy, but this is a very small proportion of the benchmark. This is a small mid-cap benchmark. We obviously have none of the super-sized oil and gas companies in our universe here. So this is a zero position. It's only 3% of the benchmark. So it's a very minimal impact. Real estate is a very large part of this benchmark for all sorts of reasons. Actually, real estate is about 900 basis points in the MSCI SMID ACWI. And so we have one company in here. This is Americold, that's cold and frozen food supply chain business that we have. But so even though we own that as a top 5 holding, real estate is still our largest area of underweight. We actually see a lot of opportunity in materials. We have some really interesting names in this area. One particular name that we like a lot, because we think, although they're good already, there's a lot of improvement they can still make. And that is Smurfit Kappa Group, which is the Anglo-Irish cardboard packaging company. We think that, we have a long experience of investing in Smurfit Kappa. We think they are a positive solution provider to one of the great challenges of our generation, which is excess single-use plastics consumption. And although through COVID-19, we've seen the benefit of single-use plastics from a healthcare perspective, from a consumer perspective, we still believe there is a huge improvement to make in reducing plastics, particularly across food supply chain and consumer-facing activities that a lot of retailers have. So Smurfit Kappa have a lot of really innovative solutions for on-shelf display of products in a much more sustainable manner that we are very hopeful will be rolled out further across the world beyond their core markets of Europe. And Umicore is another company that we hold in materials. Umicore is the Belgian chemical company that has a 50% world market share of electric vehicle battery cathode materials. So we think this is a hugely strategic area that is going to see a lot of growth, but we need to manage that growth appropriately. Umicore obviously have to mine cobalt. A lot of this cobalt comes out of Central and West Africa, places like the Congo. And Umicore are, we believe, really advanced in terms of their sourcing of ethical cobalt and making sure that their supply chain is as strong as it can possibly be. And so that's a company we have had a lot of conversation about over the couple of years that this fund has been in existence.
Okay, I have a question on the portfolio from the audience. I have understood it, it looks to me like a pretty pure play small and mid cap strategy. But one participant asks if you also use large cap exposure for tactical reasons.
Thank you for the question. That's really interesting. I mean, I'll just turn to this slide because you can see the top 10 holdings. When we started this fund, we had a $25 billion ceiling. So that was the largest company that we would permit into the fund. Now, since then, over the last 2 years, the top of the market cap spectrum has moved up to about 35 or 40 billion US dollars. Here on the bottom right-hand side, you can see the largest benchmark companies, such as Freeport, McMoran, Moderna, and Align Technology. You know, even the single largest company in the benchmark is only 30 basis points in it. So that gives you a sense of how diverse this universe is. Like I said, when talking about portfolio construction, our analysis led us to think that it would be prudent to have a number of larger mid-cap names in this fund to give us portfolio construction strength. And this, because this is an engagement fund, we want companies to be in for at least 5 years. So if you look at this slide, you'll see one particular company, which is a larger company. It's called Hoya Corporation. Hoya Corporation is a Japanese company that has a market cap in excess of that 25 billion US dollar level now. It wasn't when we bought it. This is an electro-optics company that is a key supplier to advanced semiconductor markets with their photomask blanks. So they supply people like Taiwan Semiconductor, Samsung, Micron, these type of companies. But they are also the world's second largest provider of eyeglass lenses behind EssilorLuxottica. So there are two drivers of their growth. We own this company because we really like it. We're not holding larger companies just for tactical portfolio constructions reasons. They have to be there for their own merit. But we have observed when we looked at the back test that some of the larger companies gave better risk-adjusted returns over the long term. So we were happy to have an overweight to mid-cap and an underweight to the smallest cap names in this fund.
Okay, now a question which wonders many investors is that you have like 2 years of live track record of strategy now. So could you, we already touched on a little bit on the fund acting more defensive compared with other small and mid-cap funds, but could you also speak a little bit about performance since the fund has been live, and maybe also performance in regard of traditional small and mid-cap funds without an ESG filter? Have you experienced a different behavior or better performance? Could you please tell us a little bit more about that part?
Of course, thank you for the question. So here's a performance slide. This is net of fees in US dollar, which is the base currency of the fund. I think what's really interesting here is if you look at the since inception number, so just over 2 years of track record, this is a fund that has outperformed by 200 basis points net of fees. So that's really encouraging. This is dated to the end of February 2021. And even though markets were rallying in 2021, in March 2021, we've actually seen further outperformance in a rising market. What we've seen from this fund is an ability to outperform in both falling and rising markets. And that's been very encouraging to us as the portfolio management team. But where we've seen the most clear outperformance was when the markets have had the really heavy drawdowns. Because this is a fund with a 0.9 beta, because we are short volatility, we are short, we're underweight technology, we're overweight quality, we're overweight growth. There are clear periods when the fund does better and it has more challenges. Just to put it in context, when the market drew down in Q1 2020 during the pandemic, we saw 1,000 basis points plus of outperformance from this fund. And then when the market started to rally from the mid to late spring of 2020, we made a few portfolio adjustments to buy some more cyclical names that would participate as hopefully the pandemic came under control and economies opened. So that's where we bought some more industrial companies and bought some more technology companies. I think this slide here will give you a good flavor of where that alpha has come from over the last 12 months. This is from the end of February 20 to the end of February 21. You can see we outperformed by 200 basis points over the 12-month period. The best regional contributions came from Japan, the UK, and North America, with some underperformance from our position in Pacific. One of our companies here got particularly badly disrupted by the pandemic. It's a Singaporean business called ComfortDelGro, which is the world's second largest land transportation group. They run buses and trains and taxis, that type of thing. But I'm happy to say it's recovering very nicely now. And again, you can see a good spread of sector contributions, consumer discretionary, real estate and financials were the leading positive areas for the fund, and the information technology staples industrials were the lagging areas. But I think it's the right-hand side that gives you the real flavor for how this fund is different, looking at the composition of names that are generating both positive and negative performance. Hopefully gives you a real insight into how this fund is intended to be different to a lot of the larger cap sustainability funds that we have seen launch. And here you can see that ComfortDelGro. This is that Singaporean business that we saw struggling during the pandemic, but now is starting to really accelerate as the economy is opening, not just in Singapore, but also in the UK, where they have quite a large bus operations in London. And here up in the top side, you see some of the real high flyers of the fund, such as Silicon Valley Bank Financial, which has been a beneficiary of rising interest rate expectations in the US. Aptiv, which is an electrification and self-driving play for the automotive space. And Zebra Technologies, which is a company we bought during the pandemic sell-off. This is a company that's a world leader in handheld portable computing devices for frontline key workers like logistics workers, healthcare workers, giving them better data, making them more connected, more efficient, and allowing them to work more safely in very challenging environments.
Thank you for providing us that overview. We have spoken about the quality growth bias of the portfolios before, but it's not like in usual suspects that you have like a huge tech override. You instead said that you are slightly underweight tech for the benchmark. So it's pretty diverse in terms of performance drivers. So what I'm wondering about is, while for large cap ESG investing, there are many studies available showing that integrating ESG factors into their approach leads to better returns, but more importantly, to lower risk. And that's exactly what we have observed in these funds. So is that something structural, which is also applicable to the small and mid-cap universe in your view? Or is it more that looking for these kind of companies that you have this persistent quality growth bias, which should lead or has led to that profile in the past?
Yeah, I think very thoughtful, very strategic integration of environmental, social, and governance factors into your fundamental analysis. This is a prerequisite for successful investment strategies. It just allows the fund manager to make a better informed decision about the risks and opportunities that every company faces. So I think this is equally applicable for large cap or small cap strategies. I think one of the reasons I feel so good about this strategy, and I'm so excited about it, is that in the large cap space, we have seen a lot of ESG focused money chasing a lot of very similar companies. whether it, maybe Tesla is a great example of that, where, a lot of money is chasing a relatively small number of companies, and that has led to some quite big valuation distortions, which are starting to be unwound right now. We've also seen this in some of the green technology areas, whether it's offshore wind or solar. And so far in 2021, we're seeing some of this reverse, and that's creating some performance headwinds for these funds. Whereas in the small mid-cap space, it feels like there's a very rich opportunity. There's so many companies to choose from who are much earlier in their journey towards embracing sustainable development, embracing the SDG framework, and they seem to be they seem to be warmly reacting to the opportunity to talk to investors such as us to think about how to make the SDGs work for both their business and also for delivering better risk-adjusted returns. And that's why this fund is really well positioned for the next couple of years, I believe.
Thank you very much for sharing your insights with us. I think we are now close to the end of the webinar. So thank you very much for your insights. Jamie, I just sum up some key points for our investors in German pretty quickly.
Please.
Ja, also ich wollte kurz noch ein paar Kernpunkte der Strategie zusammenfassen und vielleicht auch, was wir gesehen haben an Performance- und Risikoverhalten des Fonds. Also zunächst, die Sektorallokation überrascht teilweise so ein bisschen. Zum einen, weil es eben nicht die üblichen Verdächtigen sind, die man oft in diesen Fonds sieht, beispielsweise ein hohes Technologieübergewicht, was jetzt in den letzten Jahren zu einer Outperformance geführt hätte, sondern ein sehr diverses Sektorprofil, insbesondere dass der Materials-Sektor sogar leicht übergewichtet und nicht untergewichtet ist, überrascht. Aber das sind eben auch diejenigen Unternehmen, wo man Unternehmen finden kann, die den größeren Impact, also die quasi am meisten bewirken können hinsichtlich der ESG-Ziele. Dann, wenn man sich die Top 10 anschaut, das sieht man auch, dass der Fonds sehr, sehr aktiv verwaltet wird. Also die Überlappung des sehr großen Anlagenuniversums mit den Top-Holdings des Fonds ist nicht sehr groß. Der Fondsmanager achtet auf Diversifikation. Also wir haben gesehen, dass das größte Holding-Size um die 3%, glaube ich, lag. Das ist also sehr gut gestreut. Und was man auch sagen kann, auch wenn wir jetzt 2 Jahre Historie haben, was man schon sieht, ist eben, dass das Portfolio zum einen deutlich resilienter in schwachen Marktphasen reagiert. Wir haben ja jetzt auch letztes Jahr den Corona-Drawdown gesehen und hier hat das Portfolio circa 10% weniger verloren als die Small- und Mid-Cap-Benchmark. Und insgesamt hat auch die Ausrichtung des Fonds auch zu einer besseren Performance des Fonds seit Auflegung gehört. Also im Prinzip hat die Strategie auf der Return- als auch auf der Risikoseite profitiert. So, dann wären wir für heute am Ende unseres Webinars. Ich wollte mich bei Ihnen bedanken fürs Zuschauen und für Ihre Fragen. Und ich hoffe, es hat Ihnen gefallen. Wenn Sie weitere Fragen an uns oder den Fondsmanager haben, können Sie sehr, sehr gerne auf uns zukommen oder auch wenn Sie Feedback haben. Und ich würde mich freuen, wenn Sie wieder bei einem unserer nächsten Scope-Webinare begrüßen zu dürfen. Vielen Dank und ich wünsche Ihnen einen schönen Tag. And also many thanks to you, Jamie, for being here today, for answering our questions, also from participants. I also wish you a good day. Thank you very much and goodbye.
Thank you. It's been my pleasure.
Thank you.
Have a good day.